Bob Iacchino is Chief Market Strategist at LotusBrokerage.com. He joins us live from the CME. And still with us, Fred Hochberg, the president of the Ex-Im Bank, as our guest host for the hour. So, Bob, I don't know if we can pull up futures. We're up 110 above fair value at this hour. Is this going to be a one-day China bump? What are you seeing in terms of the trade here?
Well, I think it's definitely going to be a 1 to 2 day bump. I think it's going to sustain through the majority of the day. You know, I've been talking in terms of as a strategist, trying to find trades that'll win in the short to medium term, and that's really all we've been doing over the past 18 months is shortening our duration and trying to find trades that sort of keep us afloat from a profit perspective. But this particular type of announcement is the kind of thing that could potentially bring at least some of the institutional volume that's been on the sideline back into the equity markets and possibly push it and, more importantly, keep it above some of those key levels in the S&P that we seem to fail from generally with a half day to a day left in the week. We generally fail from those levels. We've had a pretty good run last week, and I think this is a really good start for this week.
What about the impact of the G20 later this week? I mean, that's really, this announcement that China made over the weekend is certainly going to play a role in next weekend's meeting in Toronto. How does that play out?
Certainly it does, and I think the administration already made their comment that this is a positive step, and there's been a lot of commentary in terms of this as China buying time and keeping that subject out of the G20. I personally don't think that it will, especially from a secondary political perspective. I don't think you'll see members of the U.S. Congress backing off from sort of punitive measures that they were planning for China. I don't think this is a fix for the U.S. economy or for the global economy at large, but it certainly is a positive step and potentially buys China some time through that G20 meeting. There's a lot of regulation in the U.S. coming through as well. I don't think that financial regulation is going to be backing off at all either from the Chinese announcing that they're going to at least pull off of some of those measures.
Bob, good to see you. This is Chloe in Asia. It's not a panacea what the Chinese are doing, but doesn't this add a vote of confidence that the global economy is in recovery mode?
Well, it certainly does from the perspective of China-U.S. trade relations. And once again, I think this is possibly one of those types of moves that could bring the institutional volume back in. This is not going to relate to the retail volume. It's not going to increase net flows into mutual funds which give U.S. equities that sort of natural upward bias that they have year after year from job growth and then subsequently people putting money into their 401ks. That's not going to come back off of this type of announcement. But you could see some of that institutional money that's been in cash saying, okay, globally now, this is a relaxation of one of the things that was possibly restricting a potential recovery. So I agree with you on that point. I just don't think it's a global fix. There's still some problems on the horizon, and we don't have a time frame in terms of how much it's going to float and when it's going to float completely, if at all.
You know, Fred and I were talking about China being a pivotal market for a lot of multinational companies. Bob, the largest for cars, cell phones, beer, of all things. What's the play here? Is there a sector play out of this?
Well, I don't think you can gauge a sector play yet, at least not from the standpoint of a strategist. Once again, what we've been focusing on more than anything, less even so than sectors, is duration of trades. This has been a trader's market over the last 18 months. I don't know that changes with this announcement. We could certainly start looking at a little bit medium-term trades instead of just the short-term trades. Our trades have actually lasted only 1 to 4 days over the last 18 months, as opposed to 1 to 4 months in the history of the type of strategy that we perform. So I think it's a duration play more than anything. You could start, especially in the equity markets, holding trades a little bit longer and possibly relaxing when we get some of this volatility. It could curb equity market volatility in the short term.
Do you think fundamentally, Bob, it's going to stay a trader's market, which is, that's a tough market for just about everybody, including traders?
Mm-hmm. But once again, I think you can hold trades longer. I think that's the biggest thing from the long side of the trade anyway. Obviously, as traders, we play both long and shorts in the indexes. But I just think you can hold trades a little bit longer and feel some confidence that maybe there's a floor to these moves. You know, once again, even from the institutional side, we've seen trades be taken off when normally a lot of the short-term bad news that can come in the midst of a recovery, most of the economic releases that we've been judging at least have been positive for the overall economy and the recovery. recovery. But some of the times the institutions will hold through bad news, and they haven't been doing that lately. I think this, again, one of those things that could take the duration a little bit longer, possibly put legs to the rally.
Yep. Absolutely. A lot of money on the sidelines, a lot of volatility. That's why we look to you, Bob Iacchino, to help us through the market, a chief market strategist, LotusBrokerage.com. Fred Hochberg, president of Ex-Im Bank, our fabulous guest host for the entire hour. So great to have him with us.